everybody. Welcome to the TraderMerlin Show for your Wednesday edition. Is it Wednesday already? Yes, dog park's closed today, which means it's Wednesday. Got a little bit of a special show today. As you guys know, I did a presentation in Las Vegas, a week or two ago? What's the date today? It was 2 weeks ago. Man, time flies. Did a presentation in Las Vegas. I know a lot of you couldn't have made it. So I asked if you guys would like me to do that here, and lo and behold, many of you said yes. So I apologize for those of you who were in Vegas and got a chance to see it. This will be not quite the same. I prefer to do these things in person, but I wanted to do a couple things. Number one, I wanted to make sure I had the opportunity to present this to you. And number two, I wanted to make sure it was okay with Online Trading Academy. So Online Trading Academy gave me a blessing, said you're welcome to do it. So this is on behalf of Online Trading Academy because I built this content specifically for them. And let's just dive right into it. And what I'm going to do is, this presentation was roughly 45 minutes, so I want to make sure I get in under the wire. And then what we'll do is we will dive into current markets and look at what's been happening out there today, because we had some really nice moves. So let me get rolling. And yes, hello everybody, good to see you. And of course, hit the chat as often as you guys like. I'll be watching questions as we progress to make sure that all these concepts are pretty clear. So what is that topic du jour? It's pretty simple. It just says 3 easy ways to supercharge your portfolio with digital assets. Probably the longest title I've ever come up with for anything I've ever done for Online Trading Academy or for this specific show. But that's the topic du jour. Now, as you guys know, because most of you are regular listeners out there, I am a huge fan of digital assets and cryptocurrencies and blockchain technology. I think that looking forward 10, 15, 20 years, we'll look back and go, yeah, duh, that was obvious that digital technology is going to start to replace some old archaic pieces of our current market. But with regards to retirement planning and investments, I think it's a little bit different. So I think we have to take the perspective of this is a market evolution. And I apologize, looks like the top's going to be cut off here. Maybe I can edit that one. So bear with me as I modify your screen here so we can get a little bit better resolution. And I think that should do it right about there. All right, at least we can see everything on that screen. Get a little Online Trading Academy credit. There you go. Okay, so I'm really doing an evolution, and I want to start with this evolutionary process of explaining how we got to where we're at. So as many of you might know, I worked for a financial planning company when I was much younger. I have a finance degree, so I was all excited about being a financial advisor, a broker, and really helping people manage their money. Once I got into that arena, if you will, I realized that there's a lot of vested interest, a lot of conflict of interest, and it was not this altruistic, help the customer type of approach that I had expected. It was more, hey, we got to make the company money, and if the customers make money along the way, well, that's great for them, but we don't really care. We just need to make money off of their accounts. And I was like, okay, this is not for me. I don't really like that approach. So let me start off by going through an evolution. And what I want to do is really explain 4 key things. So at Online Trading Academy, our approach is with Strategic Investor is saying there's this matrix. You have 4 main areas that you can look at to, build, maintain, and grow your long-term wealth account. So your IRAs, your 401ks, etc. The first one on that list is the one we're going to talk about today, which is investments and rates of return. Number 2 is you're looking at market timing. And I know some of you think you can't time the markets. I would argue adamantly against that. I think you can time the markets. Number 3 is going to be expenses and fees. And then you have compounding and time, which means the greater time horizon you have, obviously the more risk you can take and the better compounding is from an impact on your portfolio. So we'll focus on investments and rates of return. Now, if anybody here has an investment advisor, you typically are presented with these cookie cutter portfolios. And these are, given to them. So if someone's a financial advisor, generally whoever they're working for will say, here's our models, here's our portfolios, how old are they? Okay, well, here's this model. And I think that's kind of a bad way to approach investment. You'll see why here in just a second. So let's talk about this cookie cutter approach. And I'm going to start with the most basic one that I've ever seen, which basically says you take your age and you subtract that from 100, and that will tell you what percentage of your portfolio should be in stocks. So as you guys know, I am 30 years old. So if I'm 30 years old, I subtract 30 from 100, and that means that I should be 70% in stocks. And I would just shake my head at that because it takes into consideration nothing about current market. Literally nothing except here's your age. And then, of course, that doesn't necessarily focus on, what equities or how do I allocate to equities? I mean, do I want to do sector rotation models? I want to do some market timing there. So to me, it's old school and it doesn't make any sense. And if you look at the way it works, I built this out because I think it's really important for you to see the numbers, the actual facts. I'm not throwing BS here and making up a bunch of garbage. This is from Vanguard Advisors, right? So what they're basically saying is if you went 100% equities, which means you're zero, you're not even born yet. Anybody here got a brand new baby, it's under a year old? Well, you're putting that kid in 100% equities. Why? Because you don't need income streams. You need long-term capital appreciation. So if you did zero, they're unborn. You subtract that from 100, obviously that's 100% equities. And you can see the highest rate that you have here is 10.29. Now, I'm going to progress forward, and just keep your eye on this number over here in the upper right-hand corner, which says 9.97 now. So we move to 10. Well, 10 years of age, you're subtracting that from 100. You've got 90% equities, and I'll keep progressing. And you'll notice that as we continue to get older, our average annual rate of return is dropping because more of that portfolio is being allocated into bonds. So let's say we get up here to 100. Well, obviously you subtract 100 or more from 100 and you should be what? You should be in 100% bonds. That's what the traditional portfolio cookie cutter theory will tell you. Now, that brought us from 10.7% all the way down to 5.3. Hey, watch it, Randall. Who says I'm not 30? You haven't seen my driver's license. Look at I'm just gray and have a receding hairline from my just years of experience. Don't take away my glory, Randall. I'm 30. All right, so again, this is that very basic cookie cutter approach, and I think it is a failed model. I think it's a problem to fall for this type of portfolio analysis or allocation. Now, one thing that we do at OTA, and anybody here who is in Strategic Investor, is we have all these spreadsheets, and there's tons of those spreadsheets. Of course, if you're in there, you know what I'm talking about. And I wanted to just share a screenshot because I think that this is a much better way to view portfolio allocation. In this picture, what you're looking at are kind of three distinct categories. On the left, you've got cash, you've got steady income in the middle, and then you have variable growth. And notice we're not just saying stocks, right? Variable growth is art, gemstones, metals, commodities, real estate, variable life insurance, annuities, forex, equity positions. I mean, there's a lot of stuff that we could put under variable growth. But a couple areas where I think we don't have a lot of flexibility, like cash. Right? Cash will be a focus for today's presentation. We put this individual here has $32,000 in cash. Okay, great. Well, you're not making anything. If I'm 100 years old, I'm YOLOing on naked options. Jake the wild man there. I don't know if you want to be going that, but hey, you only live once, right? If you're 100, well, you're right near you're doing pretty good. You've passed life expectancy, so I guess why not go for it, right? Leave the losses to your siblings and your loved ones. Anyway, steady income. Obviously, there's different ways we can allocate it here, but I just wanted to show you kind of the complexity of all this, right? You want to make sure that you have everything mapped out and you know exactly what those rates of return are, and don't keep it as cookie cutter as, oh, I'm 40, I need to beat 60% stocks. To me, that's a bad model, especially with the bond bubble that we have. Now, in the previous example from Vanguard, it was really showing that if you were all in equities, it was about 10.7%. And if we went and narrowed it all the way down into bonds, 5.3. So that's really your spectrum, right? 10.7 to 5.3% in that range over X amount of time. Now, I don't like to take numbers like that at face value, so I went through and I looked at a bunch of numbers myself. Let's see, there's a 30-year-old picture. Oh, boy. It's not 30-year-old picture, Tom. That picture was taken in 1998. I think it was 98 or 99. So it's not quite 30 years. Actually, it is 30 years, isn't it? No, wait. Hey. No, it's 20-something years. Jeez, you make me feel really old. Anyway, I don't like to take the Vanguard look at it. So let me show you historical rates of return. So here is, if we go back to the 1920s, that blue line is your average, which is roughly 10% rate of return. But if we go more recent times, really since the late 50s, you're looking about 8%. So I think we could all agree that at 18, over the course of time, 8 to 10% is kind of our range for equity markets. And I think that that's fairly standard. So what I did is I went out and said, okay, what are the major pie slices that if I was creating a long-term portfolio that I would want to allocate to? And that is already one step more than the vast majority of Americans or anybody around the world is going to do with their portfolio, right? Most people are going to open their 401k, they get that little prospectus, they click on 4 or 5 little boxes and they say, okay, I guess I'll just put money into those every month without really understanding the risks, the rewards, the impacts on your portfolio. So what I want to do is I looked at the portfolio positions or allocations where I'd want to apply some money to. And again, this isn't a perfect pie chart. This is not a perfect portfolio. I just wanted to share the idea of what rates of return look like for a specific set of assets. So let's start at the top here and work our way down from the S&P 500, which this is literally the last 10 years. So I measured this from March 31st of 2012 to March 31st of 2022 to get the average for 10 years per year. 14.49% is what the S&P 500 is giving you. And most of you have been enjoying that one significantly, right? Most of you have been loving those gains from 2012 through 2022. But that's the SPY. That's what I would be looking at as my stock portion. You also have real estate, which is IYR. So what I'm doing here is I'm just saying the market segment, and then in the middle there is going to be your ETF and then the rates of return, ETF or ETN or ETP. So this is not a recommendation. I'm just illustrating what might be an option for allocations here. So that's real estate. You've got currencies, which I think are an interesting one, and I put UUP in there. Now, UUP is a basket of currencies, which can act as somewhat of a hedge, and it's not a 10-year-old product. UUP has only been around about 5 years, so I took it over the last 5 years. It's averaging 6.64% rate of return. You have bonds. Now, of course, I know I'm going to get kicked back here because you're like, well, which bond product? Why not SHY or JNK or TLT or SH? There's so many different ones. I picked TLT. TLT is a 20-year bond, so a fairly safe long-term bond product. That's averaging 4.07% over the last decade. You have gold, which everyone, go to gold, go to gold. Really hasn't done much. It's only up 1.16% per year. I mean, that's in essence, that's kind of dragging the portfolio down over the past 10 years, is it not? But we are told that we should have gold in our portfolio. And then lastly, I figured, especially since we had that conversation with John Rowland yesterday about commodities and things, you get this feeling like commodities are going to have their run, even though they have not had their run. Historically, over the past 10 years, if you look at DBC, which is the ETF I mentioned yesterday, that was down an average of 0.22% per year. So while, it's supposed to be a hedge, it's not performing well in these roaring bull markets. That said, we might see a turn here in the future where SPY drops 20% and commodities rallies 20 or 30. So commodities will have their day in the sun. It just hasn't been for the last 10 years. All right. So we've set the foundation of here was a historical model of just subtract from 100. Now we'll look a little bit more advanced and say, hey, Kev, good to see you. Let's say we advance a little bit further in time and say, okay, let's go to current market conditions. Like, how would people in today's economy build their portfolio? And that one's actually fairly simple. I actually had a guy at the trade show, which I thought was really funny, is his portfolio. I said, what are you invested in? He goes, I'm in large cap, mid cap, and small cap stocks. And I said, there's a problem there. You're poorly diversified. And this was not the gentleman's allocation. It just happened to be, he mentioned those three. But let's say you have a portfolio that's 35% large cap stocks, you've got 20% mid cap, and 35% small cap. Well, 90% of your portfolio here is in stocks. So if the equity markets plunge, it doesn't make a damn bit of difference whether you're mid, small, or large cap. You're taking the full brunt of a market decline. This is poor diversification. Now, you're probably thinking, well, they've got 10% in bonds, right? Okay, well, maybe this is a 10-year-old kid who's got, doing the old classic model. A good diversification, and again, this is not a recommendation. It's just showing you that the strength of diversification here is you see large cap, and that's been knocked from 35 to 25. So our stock exposure is significantly less with large caps. Small cap, 20%. It was 35. So now our stock exposure is actually 45%, whereas before it was 90. I've got 15% in currencies, 15% in commodities, 15% in gold, and 10% in bonds. Personally, I would have to say that this might be too high to have 30% in gold and commodities. I think that's a little high for me personally, but I'm just using this as a reference model. Okay, so I'll let you guys tell me which portfolio is going to have the better rate of return overall, right? So look at these two portfolios, the one on the left or one on the right. You notice the one on the left says poor diversification. The one on the right says good diversification. Which one do you think has the highest rate of return? Big Eb says crypto. We're not there yet, right? I'm still going through today. What I'm going to get to in just a second, Big Eb, is the future. Like, how should we augment this using crypto? And I'll give you 3 pieces. Tom says the one on the left. You know what? Most people actually get this one wrong because we are taught to do good diversification, right? We're taught to look at good diversification, and you're thinking that's going to give me a better rate of return. No. Good diversification generally does not give you a better rate of return. It's going to smooth out those fluctuations over time. So let me show you the return results. And basically what I've done is I have taken those percentages that I showed you earlier. No problem, Big Ab. Drive carefully, my friend. Do not look at the screen, Big Ab. On the left-hand side, you're going to get a much greater rate of return because you're concentrated in the best performing asset class. So the poor diversification is going to get you 10.9% based off the statistics I pulled over the last 10 years, okay? The good one, as Mario says, exactly, it's going to have lower risk because, number one, you're spreading it around more investment categories. And as the header says there, it says spread investments around markets which are not correlated. Historically, commodities and equities and currencies are inversely correlated. So it's nice to have that hedge. The problem that you're going to have here is this. Here's a chart, and I'll try to draw it in my head, or I'll try to do theater of the mind for you, Big Eb, since I know you're driving. I've got rate of return on the y-axis and time on the x-axis. So here we have the poor diversification portfolio, and you notice it looks like a really big sine wave that over time is going to go up, right? It is going to go up over time because the way markets are constructed. That's how they're built. The problem is when we're fully exposed to equity markets like that, the swings can be substantial, right? I mean, I think anybody who's exposed to the equity markets right now is feeling that pain as well. It's like, crap, we're down 20%, right? So we are actually, in a picture, looks similar to this. We're heading this big down move, and who knows how low it's going to go. But when you put in the good diversification portfolio, you'll notice that the highs are not going to be as high, but I think the key is that the lows aren't going to be as low. That's the big factor here. And the point I make all the time when you look at these kind of rates of return is, you know, if the market falls 50%, you have to make a 100% rate of return to recoup those losses. So yes, it sounds great when things are in your favor, but if you get on the bad side of a big sell-off, the market has to do a lot more to get you back to even. So this chart illustrates the impact of a good diversified portfolio. You notice that the way this is dipping is it's not getting as low as it was with the poor diversified portfolio because of these percentage swings, right? It's the slow, steady race, if you will, with good diversification. Now, I got to ask this question, which we probably already know the answer to, which is, well, why diversify? Right? Why not just throw it all in SPY, because that was the one that was getting me 14.49%. So why not just dump it all in SPY, call it a day, don't have to do any sort of portfolio management, and who cares what happens, because I'm going to get 14.49% over the course of time. And I think I think that a lot of people would fall for that and go, yeah, you're right. Why didn't I just go in SPY, right? I can buy one thing, don't have to worry about anything else. Well, here's why. If we look at diversification, or lack of diversification, I'll go back with a chart I've shown all of you on TraderMerlin many times, which is, here's the chart going all the way back of the S&P 500, going all the way back into the mid-90s. And you can see we've got yellow boxes. That was a 50% decline. So right there, when we sold off in 2000 to 2003, that market fell 50%. It took another 7 years for it to get back to break even. Right? So that's 7 years of wasted time. And then again, happened all over again in 2007 and 8 when we had our 57% decline. And it took goes all the way out to 2013. So it took 5 years for that to get up to break even, which means that's really 12 to 13. If you bought in the peak of 2000, it took you roughly 13 years till your portfolio is back to earning any sort of money, back to break even. And now I think we could all look at this picture and say, yeah, there's a reason that's been up 14.49% since the last decade. It's one of the most monumental runs you've ever seen. And we're probably going to see some big pullback here. So let's hedge our portfolio. Let's have some different investment vehicles because as we've seen in the past, here's a chart going back in the 1920s, the roaring 20s, we had an increase from 1921 all the way to 1929 of 432%. Keep in mind, the S&P currently is up over 600% off of its lows from 2009, so it's even more dramatic in our current market. But then, as always, the market giveth and the market taketh. Every 100% of those gains from 1921 to 1929 were given away in an 87% drop over the next 3 years. But we also get times like this, which will have Tom Barr just jumping up and down, where you have a period of time. In this case, you're looking at 20 years. From 1963 to 1983, the markets just bounced back and forth in a giant range bound. That's 20 years of lost capital. So not only do I make the argument that we should be market timing this, but certain investment allocations could be overweighted in different periods of time to capitalize on that range-bound market once we see it. Now, to get to Big Eb's point, because he's probably like, all right, Merlin, I don't want this to be a 3-hour show. Let's get to it. That was the old school long-term portfolio approach. And then I would say the current model, which is, hey, let's allocate and diversify and hedge here a little bit with some commodities and currencies. So now I beg the question, how do we incorporate digital assets? And of course, for many of you that have seen the digital asset marketplace fall 50+% since November, you're probably thinking there's no way in hell I'm going to do that. Well, hear me out here just for a sec, and we'll see if I might be able to persuade you to do things maybe slightly differently. So how do we do it? Well, there's 3 easy things that I would say. Yellow box approved. Love to hear it, Tom. 3 easy ways to supercharge your portfolio with digital assets. Number 1, it's going to be like a no-brainer kind of thing, is you got to buy some crypto. So you add some crypto to your portfolio. And I know many of you are going to go, oh, no, God, here we go. We're going to have some Bitcoin maxi or, going to pump me on Terra Luna, which went to 0. No, I'm not saying that at all. What I am going to do is look at historical track record. And if you look at those rates of return that we talked about earlier, that 14.49% for the SPY looks amazing. Well, I would, if this was live, I would say everybody type in a chat what you think the rate of return for Bitcoin is over the last 10 years, right? And if you can, just go ahead and type that one in. Unfortunately, there's a delay on the live stream here on YouTube, which sucks, but I'll read it out to you, as I'm sure some of you are typing in a chat what you think the rate of return for Bitcoin is each year for the last 10. And here it is. 149%. Now, if you take out the most recent sell-off, as you guys can see here, this goes back to March 31st. If I were to make it even to April or just a couple of weeks ago, it's still about 139%, even with this monstrous sell-off that it's had. Daniel and others, you're right, Tom, and you're right, it was like a gajillion percent. I'm talking per year, right? Because in order to make any sort of equivalent comparison in these portfolios, I need to know what the average is per year, right? That's what I'm basing this whole presentation is what statistical evidence can I show that will prove that cryptos can help you. Now, I know that a lot of you are going to go, no way, man, I wouldn't want to put Bitcoin in my portfolio. Well, I'm not saying, put in 30% in Bitcoin. No way, that'd be crazy. Unless you're like me, then you might put a little bit more Bitcoin. But if you don't feel comfortable with the risk, don't do it. So here's what I've done. Basically what I've said is I've now made the portfolio 5% Bitcoin. That may be way too much for some of you, might be too little. But where did it come from? Well, initially we had 15% in gold. I just took a sliver of the gold and put that in Bitcoin. So gold has dropped from 15% to 10%, and now Bitcoin has a 5% slice. So now our rate of return changes significantly. And here's how the allocations are. I'm only putting in $5,000. This is a mock portfolio with a $100,000 starting balance. And here you can see only $5,000 is in Bitcoin. At the end of 1 year, rate of return now jumps to 14.43. Now, let's put that into perspective. If we go back to the chart I had earlier, let me bounce back here real quick because I want you guys to see how dramatic of a difference is. It was 7.04%, right? It was 7.04% to be diversified. And then once we modified things and just put in a tiny, tiny, tiny little portion into Bitcoin, we jumped to 14.43. Now, I know what you're all saying. You're going, Merlin, come on. There's no way Bitcoin will sustain 149% growth rate annually. And I completely agree with you. However, I do think because it's so young and has so much potential impact on our global economy, that it will probably beat the S&P 500 for the next decade, is my guess. Right? And that's a total guess. It's speculation at my point. But because I believe that, I've allocated more into Bitcoin because I think it's going to be beating the market. Now, in this example, I'm using Bitcoin, but we could also be using things like Ethereum or Litecoin or Ripple. You pick your cryptocurrency, but make sure it's not a shit coin, right? Make sure it's not Shiba Inu or Dogecoin or Floki coin, right? Pick something that has some future prospect. And Bitcoin, I think, is probably the number one go-to, I would say, in a portfolio. Let's call it digital gold. All right. So we've pretty much doubled our portfolio rate of return, right? We've gone from 7.04, and all I did is change 5% that to Bitcoin, and now I'm looking at 14.43% rate of return. All right, great. The big challenge here is obviously this. We have massive, wild fluctuations in the price of Bitcoin. This is percentage change in Bitcoin going back into, let's say, 2017. And you can see huge moves up, huge swings. I mean, from June of 2017, it rose about 1,400% in less than a couple months. And same thing here from 2020 to the peak we had back in 2021. I mean, it was 1,000%. Coach, or the Facebook coin. It's not even, what's it called? DM now? Who knows that coin, if it'll ever be anything. So there we go. This is just the cautionary point. And I think if you are a market timing person, why am I adding more Bitcoin to my position literally as we speak? The last couple of weeks, I've added a few more $1,000 worth of Bitcoin because I'm saying, is this $5,000 chunk I'm going to buy? Do I need this $5,000 for the next 5 years? No. All right, I'm putting in a Bitcoin because I think you'll see it in 5 years. Plus, it's down over 50% off of its all-time high. Fine, great retracement. Remember, Bitcoin's done this multiple times where it's fallen 87%. So I still think there's downside move in Bitcoin, but my time horizon is not 1 year. My time horizon is like 5 to 10 years, so I should be okay there. This is the biggest risk of adding crypto to your portfolio, which is why I highly recommend very small allocations or whatever you're comfortable with. Do not put all your money into crypto, obviously. Mario says the S&P 500 returns for the next 10 years won't be like that. Probably not. Who knows? We don't know. We could see a real sharp decline and all of a sudden it just goes straight up for a few years. And I never say never with regards to financial markets. Anything is possible, but I agree with you, Mario. The odds are fairly slim that we're going to see those kind of rates of return continually going forward. Okay, let's go to the next piece, which is number 2. So the first one in our 3 easy ways to supercharge your portfolio with digital assets, just simply get some exposure to crypto, but be careful and do your homework. For goodness sake, make sure you do your homework. Number 2, I love this one. For those of you who are in the Crypto Investor Live program, you know that this is one of my favorite things. It's staking and lending, right? This is really important because basically what it's saying is if I have assets sitting somewhere, why can't I move those around to where I'm going to get a greater rate of return? And I've asked this many times of you guys that follow the show, is if you have 1,000 shares of Microsoft just sitting in your bank account or in your E-Trade account, and you get a letter from Ameritrade that says, hey, we'll pay you 3% interest on whatever the value of your stock holdings are. And you're going, wait a minute. So you're telling me that I can move my Microsoft shares, which are currently trading at $262. I have 1,000 shares, so I have $262,000 worth of Microsoft sitting at E-Trade, and Ameritrade is going to pay me 3% on that total value? That's $5,000 a year for just moving my account over. Why would you not do that, right? So I think that is part of this equation, saying now I can put my capital to use. And in that pie chart that we looked at, you don't have a lot of flexibility there. You're probably thinking, oh, I get dividends or I get interest. Well, I'll bring up the dividends thing here in a second. So let me explain for those of you who might not know what we're talking about. 1 second, let me read these cool quotes. I think a lot of traders will expect the markets to turn like it did in 2020, COVID. Yeah, a lot of people are expecting that because most people, and I apologize if it sounds condescending for anybody who's started trading after 2009, but if you started trading after 2009, you haven't experienced a bear market. You had one anomaly sell-off for a month and a half, maybe 2 months, and then it's been nothing but up. At some point, you're going to have to deal with a bear market correction and maybe a prolonged bear market. And again, I make the statement that that's really where you separate the traders from the amateurs, right? In bear markets, a lot of people just disappear. They blow their accounts. They lose all their profits. A real trader not only preserves their profits, but makes money by capitalizing on the downside move. Shingy says, Viva la Doge. You have a little pile of poop as an altar and it just says Doge on it. Oh, boy. Okay, so what do I mean by staking and lending? There's two separate things. Number one, staking is specifically for a technology in cryptocurrencies called proof of stake. And what that really means is there is a mechanism for these cryptocurrencies to communicate all the transactions. With Bitcoin, it's called proof of work. And we won't get into the consensus algorithm structure there, but it's a technology that says everybody's fighting to validate these transactions. And whoever validates them will get rewarded with Bitcoin. Proof of stake is a similar system, but it's no longer really a competition. Basically, it is you are part of an elected group, and randomly you are selected to validate the transactions and you get paid. So it's a lot less energy consumption. So you can take coins of those specific networks. And what's a proof of stake network? You could say Cardano, you could say Solana, you could say Avalanche, and there's a ton of them. Most of them are some form of proof of stake. And every cryptocurrency will have a different reward rate for staking. Like, for example, Polkadot is roughly 14%. If you look at something like Solana, it was 8, now it's about 6.5%. If you look at Ethereum, it's about 4.3%. So the new Ethereum, the Ethereum version 2. So you're going to have to shop around a little bit, and I'll show you some of those rates in a second. The other way here where it says staking and lending is where you deposit your cryptocurrency at a specific site and they pay you a rate of return regardless of whether it's proof of work or proof of stake. Doesn't matter, because all they're doing is taking your cryptocurrency and lending it out to somebody who's borrowing that and utilizing that capital. So you have two very separate ones. One, with staking, you're part of the system, right? You are helping build out and maintain that network. It's actually a safer mechanism. With lending, you're lending out your cryptocurrency and getting paid. So this is kind of a DeFi, a decentralized finance application where you can earn a rate of return, kind of like your bank is making money off of your deposits. Well, why not make money off your own deposits? One sec, Zanzibar. What would ever make the S&P repeat the last 10 years? There would have to be a hell of a lot of great new tech coming out. So you never know. One thing's for sure is it's not going to be the same thing, right? It won't be the same catalyst going forward. What I personally think is we're going to have a cleanse of the financial system, a purge, if you will, of this rampant spending. And I think that's going to be a fairly ugly piece for a couple of years. But once we clean that out, then we can reset and do it all over again like we did in 2000 and 2007. So, who knows? I'm not in the theory of predicting what might cause a future monster rally or a future monster crash. It's just if the market's going to go down, I want to be there. If the market's going up, I want to be there as well. So let me go further into the staking and lending piece here just to show you this. Let's say I have an example here of a coin that I made up, and it's called King Coin. So King Coin is fictitious. There actually probably is a King Coin, but I made this up as an example. So let's say I now own King Coin and I want to put it in my 401k, or I just want to keep it here and earn something extra. If I put it over, oops, let's not do that. That's the wrong screen. If I put it over here on Exchange A, let's call it Coinbase, right? If you look at Exchange A, they're going to offer you no money for staking. There's no lockup period, and you don't get to keep your private key. Now, there's a couple things I need to explain here. Number one, as you see there, it says no staking. It's up to the different exchanges around the world whether you earn those rewards or not. Lockup period. In many cases, your lockup period will prevent you from withdrawing these tokens for a certain window of time. So in this case, there's no lockup. You can take it out anytime you want. The third dot there is no private key. Now remember, private key, most of you know this as well because I've mentioned it so many times here on the show, but I might have some new viewers. A private key is what allows you to access your account, and it is the only way to access your account. So if you keep it on Exchange A and it says no private key, that means that the exchange has the private key, and it's their possession. If you keep the private key, that means you own it. Nobody can seize it. Nobody can take it away. It's in your possession. So if you're somebody who is anti-government and the sky is falling and you're a doomsday prepper, you probably want to keep your private key. So let's look at 4 different examples. Number one, I don't really see any benefit of keeping it on Exchange A. I don't get my private key. There's no staking rewards, so why bother? So I'll shop around, and maybe I get to Wallet B. Now with wallet B, I now get to make 6% on my deposit. So already it's a 6% increase, which is awesome. No lockup period, and I get to keep the private key. So there is really no reason on earth why, in these two examples, if these are your only two choices, there's no reason why you should keep your money at A. No argument. I would love to hear why you think you would want to keep it on exchange A. You got no private keys, no staking reward, no lockup. Down here, I'm making 6% and I keep control of everything. So option B wins here dramatically for me, but we're not done yet. Now we've got exchange C, which will give me, it's no longer staking, but it's going to give me a 5% lending reward. So this could be something like Crypto.com or Nexo or Celsius or Voyager. There's a one-day lockup period, which means 24 hours you can't pull your money out. And then here you can see no private key. So that's a toss-up. I would still go with option B here simply because I get the private key and I make more money. So let's see what else we have. Exchange D is going to give me 10% staking, a 7-day lockup, and no private key. So this is where we have to kind of make decisions on our behalf, which is, well, where do I want to keep it? For me personally, there's only two choices here. It's going to be Wallet B or Exchange D. That's it. And I would probably go with Exchange D. Really depends on how I felt about the current, political position of our government. Like, what are they going to seize, assets, etc. But if you go to Exchange D, you're going to make 10% on that King coin. They'll lock it up for 7 days, but who cares, right? This is designed to be a long-term investment. I mean, my Bitcoin, I'm not selling for another decade. Fine, I'll lock it up for, can I make even more if I lock it up for longer? The only worry here is I don't have my private key, right? So I just wanted to show you this because there are different ways to earn income on your cryptocurrency. So let's go forward and give you some examples, because a lot of people go, well, Merlin, this is just like dividends, right? Oh, well, here's Chevron at 3.5% dividend, or JP Morgan at 3.25. You can see some pretty major names in there. These are some of the big boys, and this is what they're going to pay you. Okay, fine. But here's what some of the staking and lending rewards are for crypto. I mean, some of these are pretty darn substantial. 18% for Kusama, 14% for Polkadot. I mean, these are some pretty big names paying some pretty big rewards. And again, I think there's a lot more risk with something like Kusama versus Chevron Corporation. Significantly more risk. But this is where we have to make that evaluation and say, is it worth it to me to maybe put a little bit into something like Kusama, because I think that maybe the technology is going to be great going forward, and I'll also earn 18% on top of whatever price gains there are. And that's a decision that we each have to make for ourselves. Now, real quick, let me get to a couple questions here. Dr. Bonnie says, I thought you said yesterday it's best not to stake our Ethereum yet. Correct, right? Ethereum is probably the one red flag I would say with regards to staking, because if you stake Ethereum, you cannot pull it out for any reason until they do the merge, which is supposed to happen. It was July. Now it's August, right? It sounds like it's pretty solid that it's going to be August, but honestly, it was supposed to be March of this year. So it keeps getting delayed and delayed and delayed and delayed. So yes, you probably shouldn't stake your Ethereum. Part of my Crypto Investor Live program tomorrow, I will actually be doing moving Ethereum around, and there's one spot I found where I'm actually going to be getting 13% on my Ethereum, which will be very interesting, but I have to commit it for 1 year. So, I'm doing this process right now, which is shopping my crypto around, saying, where can I earn money on top of it? Because I'm going to keep the Ethereum, I'm going to keep my Bitcoin, some of the other ones I might sell, but let me earn some interest on those as we go forward. So, let me see, second question. How large or small of an account before you would move off of Coinbase type of exchange? Doug, I wouldn't put any sort of limit on the account size, right? If you're keeping your, Bitcoin at Coinbase, and there's another exchange out there that has the same security risks and no lockups, but they're going to pay you 6% for your Bitcoin, why would you keep any of it at Coinbase? That makes sense? Like, why would you do that? Because 6%, let's say you have $10,000 worth of Bitcoin, well, if you have it on Coinbase, you'll make zero, goose egg, nothing. If it goes up, you make money. If it goes down, you lose. But if you have it on another exchange, a lending protocol, let's say, that's going to pay you 6%, well, that's $600 a year. Why not, right? But how do you trust these platforms for 1 year? That's the good point. You really kind of have to stay with some of the bigger ones. There's a lot of little stuff out there, which has been making me a little bit nervous with regards to where I'm putting some of my capital. But so far, the returns have been pretty decent. I have not been hosed or screwed by any of them yet, knock on wood, because now I'm going to get screwed now. But I'm sure it will happen where I'll put some money on an exchange that's giving me a pretty good rate of return and maybe have some issues. So what do you think of Anchor Protocol? I wouldn't touch it. You're talking Anchor Protocol or crypto? There's two separate things there. Anchor Protocol, will pay you 20% interest on your UST. Well, UST went from $1 to 7 cents, but we'll talk about that one a little bit later on. Not your keys, not your crypto, right, Singy? Not your. If somebody else has your private key, then they own your crypto. Let's see, what else do I have? Have you had any trouble getting your money out of these exchanges? I have not, Margaret. I've had no trouble. However, I'll tell you this. I've had a lot of people say they've had problems getting their money off of some exchanges around the world. So make sure you vet them, right? If you're going to open your account somewhere, go on social media and see if anybody has had issues. I heard nightmare stories where someone's got like a $50,000 Bitcoin account and they're charging them $20,000 to withdraw the Bitcoin. That type of stuff will show up on social media very quickly. So make sure you do your research before you just start putting your money into some high earning account. All right, let me wrap this one up because I know I mentioned 45 minutes. I'm almost there. So how does this now look if we take that Bitcoin and now start lending some of it out? Remember, when we moved over from the good portfolio, which is about 7.04%, and we put it into 5% Bitcoin, we doubled our rate of return to 14.43. Now let's say I take Bitcoin and I take that 5% that I have of Bitcoin, so $5,000 worth of Bitcoin, and I do 8% lending. So I have a lending side, lend it out there, and I make an 8%. Well, that's now bumped me up about another 0.4%. And it may not seem like a lot, but this adds up over time. So now my rate of return has jumped from 14.43 to 14.83. Now, last part, which to me is the best part. Save the best for last, they say. So the third way that we can look at supercharging your portfolio with digital assets is simple. Stablecoins. And I know a lot of you are like, oh my God, I heard what happened to UST. That's a stablecoin. There are multiple types of stablecoins, and some can be very, very dangerous. For those who don't know, let's just look at what a fiat currency is. A fiat currency, like the US dollar, right? US dollar is backed by the full faith and trust of the government that issued it. I don't trust my government. I really don't. Unfortunately, I love my country. I think it's got some of the best people on the planet. But our government, I think, is absolutely screwed up and self-interested and greedy and power-hungry. But anyway, this isn't a political show. Right now, according to the FDIC, this is what you can earn. 0.06% interest. That is pathetic. But that's what the average is according to Federal Deposit FDIC as of May 2nd. All right, so it's a couple weeks ago. But that's what you would earn. Now, a stablecoin is essentially taking that US dollar and making it digital, right? And there's multiple ways. I'll explain those here in just a second. But basically what it is, it's a digital token that's backed by dollar-denominated assets held at regulated US institutions. And with that, I can earn 13% interest. So if you're looking at these two things, you're probably thinking, well, why the hell would I keep it in US dollars? You'd keep it in physical US dollars because it's FDIC insured. The one on the right, USDC, which is probably the only stablecoin that I would look at putting money into, that one is not FDIC insured yet, but I assure you in the next year or two, my guess is by the end of next year, we will have full-on regulations on stablecoins, and they will have to follow specific rules. Now, let's say you're looking at different stablecoins. Guys, there's multiple, and some of you heard of UST, and I'll explain what happened there in just a second, but there's 4 types of stablecoins. Number 1 is fiat-backed, which means it's physically backed by a fiat currency. That could be the dollar, could be the yen, could be the pound, could be the Russian ruble. It's going to be backed by physical dollars, and in my opinion, the only ones that you should be putting your money into are fiat ones that are audited. So if it says it's got a market capitalization of $1 billion, there better be $1 billion in a savings account or U.S. government bonds, and it needs to be audited. So USDC is audited. Actually, it's attested, which is a very interesting thing. But at least there's someone who's looking at the statement saying, yes, this money is in fact sitting in accounts. Now, the second one here is crypto-backed. This is something like DAI, D-A-I, which you deposit Ethereum, and when you deposit Ethereum, you can now mint DAI stablecoins. So that's a little not quite as safe, The third one here is just non-collateralized. That would be something like UST, which completely collapsed. These are generally algorithmic stable coins. That one has gone from $1, where it should stay at, and it fell all the way down to a couple of cents. I think now it's up to 7 cents. But this is one type that's very dangerous. You have commodity backed, so you can have some that are backed by gold and silver. Bottom line is they're not all the same. We will get some regulation coming in here. And Margaret, I do believe that it will be, the regulator will be the FDIC. So I think it's going to be SEC to start, and then it'll go under the guidance of the FDIC. And as long as they meet specific rules, and in my opinion, what will happen is because of what happened with UST, the implosion of this algorithmic stablecoin, the government's going to say, hold on, we want it to be fiat backed by US dollars. So if you want to be a stablecoin, a USD stablecoin, it's going to have to hold US dollars or government bonds. And remember, this is not just about safety for the consumer. Now, certainly that makes it a safer product for the consumer if it's audited and the money's actually backing it up. But what's more important in all of this, and completely, in my opinion, gets swept under the rug in this whole discussion, is the government's main interest is not your safety. It's not to say, oh, let's protect customers. That's a bullshit cover-up talk track. What's more important is the preserving of the power of the US dollar and making sure that the dollar stays the reserve currency of the world, because without that, America is in serious trouble. If we have all of a sudden some other country becomes the reserve currency, the US loses massive power, massive control. They can't let that happen. So what they're going to do is they're going to say, you can have a stable coin, but it has to be dollar-backed or also government bonds, meaning you're using US dollars to support the government. So it's a win-win for government agencies if a US dollar stablecoin is backed by cash and government bonds. So that's what will happen going forward, in my opinion. Now, how does this look like if we add some stablecoins to the portfolio? So what I did here is I took the currencies section was 15%. So what I did is I split that in half. I put 7.5% in currencies, 7.5% in stablecoins, and I'm taking that stablecoin, which is, should stay at $1 and not move at all, right? Well, I'm going to deposit that and make 13% yield. So now my portfolio jumps all the way up to 15.32%, but this is not the most important thing. I know a lot of you are looking going, well, we went from 7.04, we added Bitcoin, we went to 14.43. We added Bitcoin and some lending, we jumped to 14.83%, and now we add stable coins and we're at 15.32. Okay, great, that's fine. That's not why this is so important. This is why it's so important. Here is your good versus poor diversification, right? We looked at this one earlier. If you add in the stable coin, notice what happens. When the markets crash, the stable coin doesn't crash. So you're sidestepping 100% of downside losses with that small portion that's in stable coins. So what's happening is it's no longer dropping as far as these other two portfolios because you have more of an allocation into a stable asset. And then as time goes on, when markets start to move up, you're still making that 13% regardless of market activity. So to me, this is really important because notice the curve. Over time, the highs are going to get higher and the lows are going to get higher. So it's a win-win by adding in stablecoins. The real risk for all of us is we don't know the regulatory environment going forward. Now, of course, there's a lot of different things we can look at with like DeFi. There's, a whole world of stuff that opens up with decentralized finance and swapping and different protocols. So to me, this is just the tip of the iceberg with regards to how we modify our portfolios. But I think it's kind of silly for us not to use some of these tools to help increase our rate of returns on our portfolios going forward. So quick plug and shout out. Thank you, Online Trading Academy, for letting me do that one for you guys. There is a free intro to crypto course. It's actually in the description on this YouTube channel. So for anybody out there who would like to take a free crypto class, I made that one. It's really just 6 very, very, very introductory videos. Of course, from there, you can take the Digital Assets program, which is paid for, or the Crypto Investor Live program. Those are paid for as well. And you can also follow me on Facebook, Instagram, Twitter, blah, blah, blah. Got to plug my own stuff there. All right. So there we go. I'll let you guys type in questions there. That's kind of the presentation I gave in Las Vegas. It took me 49 minutes, so I was 5 minutes over. But I think my goal is to show how archaic it used to be how it is right now and what the future holds for us. And I think it's a compelling argument to increase our rate of return a little bit, but also by reducing risk. It's not just about the increased rate of return. It's more important, that last chart I showed you, which shows that the lows, your portfolio won't be dropping as much. So when you get a 50% drop, if you were, let's say you just bought SPY and the market falls 50%, you lose 50%. But if I kept, let's say, a third of that portfolio in a stablecoin making 13% rate of interest, if the market drops 50%, the S&P, yeah, that portion that's in the S&P will drop 50, but I now have an anchor with that stablecoin that I can be earning interest on going forward. So to me, very important, very important. Let's see. Bond says, if you held bonds and collect free interest on that too, wouldn't that more than what gold can promise? No, not necessarily. So what you're getting there with bonds is a predictable stream of payments, right? That's one of the beauties of bonds. We have this consistent stream of payment. I mean, it depends on the bonds, obviously, but you get a consistent stream of income. That's why bonds are so important for the elderly, is because now you can see, you'll know what your expenses are. Great. Set up a bond portfolio or a bond ladder or a barbell so you can continue to get that rate of return. The difference there is, yes, you're getting consistency, Alan, with your bonds. However, you might get that period of time where gold all of a sudden moves up 300% in a year. Not going to have that happen with bonds. You shouldn't have that happen with bonds. There's a bigger problem there. So bonds, yeah, we didn't talk much about the income stream perspective, but that's a large part of the reason why people want bonds in their portfolio. But I think the deeper you dive into it, you realize that this is the most manipulated bond market that the history of markets has ever seen. Right? The U.S. Federal Reserve has just been buying and buying and buying and buying and buying and supporting this market like no one ever has. So, for the past, since 2009, the Fed has been the biggest buyer of bonds in the world and it just keeps buying more and more and more. That can't happen. I mean, here you have a drug dealer who is buying all the drugs and creating a monopoly. Well, at some point, in this case, they're not using their drugs. They're just buying them all up, and it drives the prices up, right? Drives the price of bonds up and yields go down. Now, all of a sudden, they're not buying anymore. And matter of fact, they're unloading. So now you're starting to see those bond yields are rising. And of course, that means that those the bond prices are going to start to fall. So bonds are actually a dangerous place for anybody, a more dangerous place than historically advertised, I would say, especially for those nearing retirement. Hey, Miles, thank you very much. Appreciate that, my friend. Always nice getting some contributions. I'm glad to see you around. All right, let me real quickly do this so I don't see any more last-minute questions. I want to make sure I get out in under 1 hour. Here's your economic calendar for today. It was, do me a favor. Like the show. If you are new, maybe you stepped in late, hit that subscribe button as well. I think that actually is the single best thing to help the show is hit the subscribe button, like, share it if you want, especially if you have somebody who's nearing retirement. This might be one to help them out a little bit. Here's what happened today. So for those of you who were watching the popcorn trade of the day, which is NVIDIA, well, it wasn't as exciting. It shows up here as a nice gain on earnings, but they actually missed. They were down 6%. Yeah, they beat earnings, but they were down 6%. Right now it's around 6.63%. The one that really impressed me was this Nutanix, right? I don't know Nutanix at all. I'm assuming a drug company, but check that one down there at the bottom. Nutanix, they beat earnings by a huge margin. They went from negative 22 cents to negative 5. It was just awesome. And they're down 25%. Actually 27% right now. So this is your earnings for today. Economic calendar for today as well. What is noteworthy here, these numbers are bad, folks. These numbers are bad. Durable goods orders were way less than expected. They already lowered the bar by 50% and were lower than expected on that. This to me is starting to paint that grim picture we've talked about. And we'll see how this unravels going forward. But that's what happened today. Here's tomorrow, Alibaba, Macy's, Costco. Boy, all eyes on Costco. That is for sure, especially for those of us who are in the retail space right now. Costco over the past couple of weeks has gone from over $600 to right around $400. So it's been a huge drop, 30% drop in the price of Costco's stock. Dangerous, but maybe that's a sympathy sell-off because retailers have been doing so bad. You also have Baidu, Medtronic, Marvell Technologies, and Ulta Beauty reporting earnings tomorrow. And then your economic calendar, more stuff. If you're trading in Canadian markets, you've got retail sales numbers coming out, which is expected to have a huge jump for Canada. For the U.S., our preliminary GDP numbers come out. And to me, that is going to be interesting. They're expecting it to drop from negative 1.4 to negative 1.3. So a slight improvement over the previous reading, But still, that would make it the second consecutive quarter of negative GDP growth, which is not a good thing, especially when you deal with this dreaded R word that people call recession. All right, last part. We had new home sales, which were atrociously bad. We talked about that at the end of the show yesterday. It was like, oh crap, that new home sales were really bad. Seeing those the quantity of homes sold really declining. And if you notice, if you look at charts like Toll Brothers, who reported earnings earlier, they reported on Tuesday. You can kind of see that's reflected. I mean, Toll Brothers has gone from $75 down to 48. It's 48 today, but it was just at 45 yesterday. I mean, that's a pretty significant drop. To me, the Toll Brothers knows. They know if they're not selling homes. You look at KB Homes. Here's another one, right? They're all down significantly. Lennar, let's go to Lennar. These home builders are getting crushed. I mean, Lennar was up at about 116, dropped all the way to 172. Ouch. Brutal going forward. So we'll see what happens tomorrow with pending home sales. You can see there, pending home sales comes out 30 minutes after the market's open, and that's expected to fall substantially from negative 1.2 to negative 1.9. So they're basically saying a lot less homes are selling. Gee, I wonder why. Mortgage rates have gone from 3% for a 30-year fix to over 5% in a period of 6 months. I wonder why we're seeing home sales slide. Oh, well. Anyway, that will do it for me for today. Hope you guys enjoyed that one. Again, thanks to OTA for letting me do that show here. I know that they like to keep things within their walls, but it was nice to get to share that one with you. Hope you enjoyed it, learned something, and maybe share it with someone that you think might find that beneficial. Daniel says, what about crypto in New York City? Unfortunately, you might have to use a VPN to get around that. Crypto in New York City is shunned, it seems like. New York and a couple other states are really aggressive towards it. I'm assuming, in my opinion, Daniel, that once we get some clarity from our regulators, whether that's the SEC or just the Treasury, once we get that clarity, I think that New York might lighten up a little bit, right? They're trying to protect investors, and I get that. I think it is important because a lot of people are buying stuff they just don't need to be buying, right? They're getting scammed into all these shit coins, and the crypto world is fraught with fraud. There's so many scammers out there. Be careful. I mean, look at all these NFTs right now. They're absolutely imploding. There's people that spent $300,000 for an NFT, and now they're like, hey, give me $5,000 for it. No, it's going to go to zero, buddy. It's garbage. So be careful out there with these cryptos, etc. Let's see. What else do I got? What will happen if your home price is below your loan balance? Your lender doesn't care. As long as you keep making those payments, right? Because I don't believe that your lender is going to be out there reassessing the value of your home. I've never had that happen, even in down markets. I've never had a lender come out and say, hey, we're going to reevaluate your home. As long as you are making your payments, the lenders will leave you alone. Did you ever buy a house in the mountains that you wanted? No. I made an offer. I tried to buy one, and somebody offered way more money, and I did all cash. I did all cash. I think I did all cash. I think I did $20,000 or $30,000 over asking price, and someone came out at even more than that, and I was like, you can have it. I'm not chasing. I'm not going to let my emotions get the best of it. In another couple years, I'll buy back in the mountains at a cheaper price. Let's see. Yeah, I'm interested in what Baba will be doing too. I like Alibaba. I like Alibaba long term. I think that there's actually a lot of potential there for Alibaba. All right, for the sake of Big Ab, I've got 120 seconds left to wrap up the show. Anyway, thank you guys so much for joining us. Hope you enjoyed the show. Again, hit that subscribe button, hit the like button, share it if you want. If you have emails and questions, send them to, actually put them down below the YouTube video. That's the best way to get questions answered. Just go to, actually you can do it on any video, but the most recent one's the best place to do it. Just type in your question there or comment, or you can email me at tradermerlin@gmail.com. That said, hope you guys have a fantastic day. I will talk to you all on tomorrow's show. Take care. And Mimi, thank you very much. I didn't even say thank you. And Koja, thank you guys so much for the donations. I'll give a big shout out to you guys.